How does an investment property reduce your tax? Having an investment property has some major tax advantages which make it pretty exciting. Let's look at the following example where you own an investment property that's worth $500,000. It's got a $450,000 loan and a 5% interest rate. It's renting for $500 a week or $26,000 per year. Let's say you earn $100,000 per year, which you pay tax on through your employer. When you own an investment property, the rental income is then added onto your taxable income, meaning you won't have paid enough tax on this total amount. So unless you make some claims against it, you are going to have a tax bill and not a tax return. But fortunately, there are plenty of things you can claim back. You can claim the loan interest, the rates, rental management fees and insurance, which we call cash deductions. This means money has to physically leave your bank account before claiming it back. But there is one thing that really makes a difference to property investing, and it's called depreciation. Depreciation is essentially the wear and tear of fixtures and fittings within your property, such as carpet, curtains or kitchens. The government acknowledges that these items won't last as long as the building, so allow you to deduct their value, meaning that they can be replaced sooner. This allows you to put money aside to replace these items with new ones, putting money back into your hands so you are not out of pocket. It also keeps the property looking better to attract good tenants and assists the broader economy with ongoing spending. The reason depreciation is such a good tax advantage is that it's an on-paper or non-cash deduction, meaning it's not money that you're dishing out of your pocket every year, and as you can see, when combined with the cash deductions, the depreciation can really drive down the amount of income that you're required to pay tax on. So, back to the example. In this case, your taxable income went up to $126,000 and then came down to $83,550. But you already paid tax on $100,000. Therefore, you are now entitled to a tax return on the difference of $16,450. So, once we run through the calculations, this would work out as a tax return of around $5,931. Now that makes a huge difference. If you were getting back over $5,000 on a property, then that's about $100 per week, and if you're getting an extra $100 a week back from your property on top of the $500 a week rent, then this is a 20% increase in the total return that the property gets back. This can be the difference between a positive cash flow property and a negative cash flow property. Learn more about how you reduce your tax through investment property and become a successful property investor. Take the first step today by completing our expression of interest form, and one of our expert staff will contact you to book an appointment to discuss this with you in person at any one of our convenient office locations.